The letter arrived folded inside a church donation envelope. That's what made it so easy to miss. No red warning stamp, no giant IRS logo, no dramatic headlines screaming danger, just a quiet little notice buried beneath grocery coupons, pharmacy receipts, and a birthday card from Diane's granddaughter. But when 72-year-old Diane Holloway opened it at her kitchen table in Cedar Rapids, Iowa, her hands started shaking. Because after 47 years of donating faithfully to her church, she had just discovered the IRS quietly allows retirees over 70 and a half to use 7 different tax strategies most seniors never hear about. And those strategies could have saved her thousands of dollars every single year. Thousands. Money the government had already quietly collected while Diane believed she was doing everything correctly. Listen carefully, because this is one of the most important retirement tax warnings you ever hear. The moment you turn 70 and a half, the rules change, not slightly, dramatically, and the overwhelming majority of retirees never realize it. Most seniors know the famous retirement ages, 59 and a half, 62, 65, 73. Those ages get all the attention. But 70 and a half? That age sits quietly in the shadows of the tax code, like a hidden doorway most retirees walk right past. And the IRS is counting on you not understanding what unlocks there. Because once you cross 70 and a half, you gain access to tax strategies that can lower taxable income, reduce Social Security taxation, avoid Medicare premium surcharges, shrink future required minimum distributions, and potentially save tens of thousands of dollars over retirement. The part nobody tells you? Some of these strategies become less powerful once RMDs begin, meaning the clock is already ticking. Diane discovered this too late. Her husband Walter had died the year before, after a sudden heart attack while shoveling snow outside their home. One moment, he was clearing the driveway. 20 minutes later, paramedics were carrying him into an ambulance while Diane stood barefoot in the snow, screaming his name. After the funeral, Diane focused on survival. Pay the bills, answer the sympathy cards, figure out Medicare, meet with the CPA. Ordinary widowhood survival. But 3 months later, while reviewing retirement withdrawals, her accountant asked a question that stopped her cold. Have you been using qualified charitable distributions yet? Diane blinked. Using what? That silence right there is costing retirees billions. Because millions of seniors donate money every year directly from checking accounts, while completely unaware the IRS quietly created a different route after age 70 and a half. A route that can legally shield thousands from taxation. This is where the trap begins, and where the survival manual starts. Trap number 1. The Qualified Charitable Distribution, QCD. This is the single most powerful retirement tax strategy most retirees never use. And the reason is simple. Nobody explains it emotionally. They explain it like accountants. Cold, technical, forgettable. So let's explain what it really means. Imagine Diane needs to withdraw $18,000 from her IRA this year. She also plans to donate $8,000 to her church and local food pantry. Most retirees do this the normal way. Withdraw the money, pay taxes on the withdrawal, then write checks to charity. That sounds harmless, responsible even. But the hidden rule is devastating. That withdrawal becomes taxable income, which means it can increase taxation on Social Security, push retirees closer to Medicare IRMAA surcharges, and trigger larger effective tax rates. The financial guillotine swings from multiple directions at once. But after age 70 and a half, the IRS quietly allows retirees to send money directly from an IRA to a qualified charity. That money never hits taxable income, never touches adjusted gross income, never triggers the same tax cascade. The charity receives the same money, but the IRS gets cut out of the route entirely. That's the hidden doorway, and most retirees never walk through it. Diane nearly cried when her CPA showed her the math. Over the previous 8 years, she and Walter had donated nearly $74,000 traditionally. Had they routed that through QCDs correctly, the tax savings could have exceeded $14,000. $14,000. Gone, quietly handed to the system simply because nobody explained the rule properly. This is where retirees lose money invisibly. Not through scams, not through gambling, through information gaps. And the government keeps the receipt. Stop the video. If you are over 70 and a half and donate any money to churches, food banks, animal rescues, veteran organizations, or charities, you need to understand QCDs immediately. Because every year you ignore this strategy, The trap keeps tightening. Trap number 2, the hidden Social Security tax bomb. Most retirees still believe Social Security is mostly tax-free. That misunderstanding destroys people financially, because the taxation thresholds were never properly adjusted for inflation over decades. That's the hidden rule. As retirement withdrawals increase, up to 85% of Social Security benefits can become taxable. Think about how brutal that sounds emotionally. You worked 40 years, paid payroll taxes your entire life, finally retire. Then the government taxes the retirement benefit itself, because your withdrawal structure triggered the cascade. This is why QCDs matter so much, because keeping money out of adjusted gross income changes the entire chain reaction. Diane's CPA showed her something terrifying. By routing charitable gifts through QCDs instead of regular IRA withdrawals, she could potentially lower the taxable portion of her Social Security dramatically. Same donations, same lifestyle, same retirement, different route, thousands saved. That's the part nobody tells seniors. Retirement taxation is often about routing money intelligently, not simply earning less. Trap number 3, the pre-RMD window. This is one of the most overlooked opportunities in retirement planning. Listen carefully. QCD eligibility begins at 70 and a half, but required minimum distributions will not begin until 73 or even later, depending on birth year rules. That creates a hidden planning window, a gap, a strategic period where retirees can reduce IRA balances before forced withdrawals begin later. Why does this matter? Because future RMDs are based on account balances. Larger balances mean larger forced withdrawals, larger tax exposure, larger Medicare risks, and more Social Security taxation. That's the engineered system. The IRS delays taxation for decades, then eventually forces extraction later. But retirees who strategically reduce balances earlier can shrink future damage. Diane's CPA estimated that strategic QCD use during the pre-RMD years could lower her future forced withdrawal exposure substantially over time. This is the part nobody tells retirees. The years between 70 and a half and RMD age become some of the most important tax planning years of your entire life, and most seniors waste them completely. Trap number 4, the last clean Roth conversion window. This one becomes terrifying once retirees finally understand the timing. Before RMDs begin, many retirees still possess valuable lower tax bracket space. That space can be used for Roth conversions, strategic conversions, controlled conversions. But once forced withdrawals begin, those lower brackets often start filling automatically. That's the second blade. The retirement account that once looked like safety now begins crowding out flexibility. Diane's CPA explained it carefully. If you wait too long, he said, the IRS begins choosing your withdrawal timing for you. That sentence changed her entire understanding of retirement. Because retirement planning is no longer just accumulation, it is controlled extraction. And whoever controls timing often controls taxes. The system is mathematical, not emotional. Trap number 5, the Medicare IRMAA trap. This one quietly crushes retirees every year, especially widows. Because Medicare premiums increase based on income thresholds, cross the line, and premiums jump, sometimes dramatically. One extra dollar above certain thresholds can trigger thousands in additional annual healthcare costs. That's the financial cliff most retirees never see coming, and retirement withdrawals directly affect it. This is why invisible strategies like QCDs, Roth withdrawals, and provisional income management matter so much. Because every dollar added to adjusted gross income can trigger multiple layers of damage simultaneously. Taxes rise, Social Security taxation rises, Medicare premiums rise. One movement affects everything. That's the engineered system retirees are now navigating. Trap number 6, the widow's penalty. This one emotionally devastates surviving spouses. After Walter died, Diane's taxes became harsher, even though household income fell. Think about how cruel that sounds. One person dies, the survivor loses companionship, and often loses tax flexibility too. Married filing jointly disappears. Single filer thresholds compress. Medicare IRMAA limits tighten. And suddenly the same retirement money becomes more dangerous. That's why the retirement tax system feels colder after widowhood. The system is counting on retirees not planning for survivorship, and most couples never do. Trap number 7, the temporary senior bonus window. This is another hidden opportunity many retirees will completely waste. Temporary deductions, temporary windows, temporary tax opportunities. The problem? Most retirees hear about them years too late, after the window closes. That's the hidden pattern inside the system. The rules quietly change, but ordinary retirees stay emotionally frozen using outdated strategies. Meanwhile, the government continues collecting, quietly, patiently, mathematically. Now let's talk about the real danger. Because the real danger is not ignorance. The real danger is delay. Waiting too long, waiting until RMDs begin, waiting until widowhood, waiting until taxes spike, waiting until Medicare surcharges appear. That's when the trap fully closes. Listen carefully. Retirement planning after 70 is no longer about simply saving money. It is about controlling the flow of money, controlling taxation, controlling exposure, controlling timing. Because once the IRS controls timing, your flexibility starts disappearing year by year. That's why retirees who understand these hidden rules often legally save thousands annually, tens of thousands over retirement, and sometimes even preserve generational wealth. Not because they are richer, because they understand the system earlier. Now here's the survival strategy. First, if you are over 70 and a half and donate to charity at all, learn QCD rules immediately. Second, calculate your provisional income and understand how retirement withdrawals affect Social Security taxation. Third, review Medicare IRMAA thresholds carefully before large withdrawals or conversions. Fourth, understand the pre-RMD window before it disappears. And finally, stop assuming retirement tax planning ends after retirement begins. For millions of Americans, that's exactly when the real financial ambush starts. Save this video. Save it, because most retirees over 70 are unknowingly overpaying taxes right now simply because nobody explained these hidden IRS rules clearly. Comment your age and state below, and tell me whether you had ever heard of qualified charitable distributions before today. Because for many retirees, the difference between financial stress and financial stability come down to understanding one hidden IRS rule unlocked quietly at age 70 and a half. My name is Ivana Forbes. Subscribe now for more retirement survival warnings, IRS traps, Medicare dangers, and hidden financial rules threatening ordinary Americans over 60. And remember this, the retirement system is not just testing how much money you saved, it is testing whether you understand the rules well enough to keep it.